What's up, everybody? My name is Joe Brown, and this is Heresy Financial. A lot of people right now are starting to recognize that inflation is starting to run out of control, and we're seeing new rhetoric come out of the Federal Reserve's mouths as they look to combat inflation. They're stepping out of bond buying, they're tapering their asset purchases, talking about sooner interest rate hikes after that. But today, I want to go into the details, look at the data, look at the charts to show exactly why that's not going to work this time, because unlike the situation that the United States was in back in the 70s when you had Volcker come in, just start jacking up interest rates in order to get a handle back on inflation, put it back in the bag. That can't happen this time. We are in a very different spot, and I'm going to show you why. Ready? Let's dive in. All right, let's take a look at the numbers. We're going to start off looking at the total national debt, and we can see that we're sitting pretty here at around $28 trillion. Just in case you're not aware, it always says on the top of these charts how they are measured. So this is in millions of dollars, so it is 28 million, which is trillion. A million is a trillion. So we're sitting here at around $28 trillion. Now, that number is astronomical, so much so that most people it's not a real number, right? It's so big that it's like, I don't know how to process that. Let's put it in terms that I can understand. So one thing that a lot of people will do is, what is that per person? Because per capita, per person, we can see that as of 2020, this number was $80,800 per person. That's the amount of debt that the U.S. government owes. Is if every single person contributed $80,000, $81,000, then they could pay it off, right? So that's how big that number is. But that's not helpful for understanding the plight, the situation that they're in terms of interest rates. So one other piece of data that people like to look at is this one, the total national debt as a percent of GDP. And you can see here we're sitting right now around 122%. So that means the total size of our economy, which is calculated using GDP, which is a flawed measurement, but it's a measurement people use. You would have to, let's say, just hypothetically, you can't really do this, but liquidate our entire economy, sell it all, 100% of it, plus another 22% to pay off our national debt. So that's number one. That's a lot higher than the 90% number that is typically given by economists like Reinhardt and Rogoff. Reinhardt and Rogoff. In the book specifically, they write about this a lot, is this time is different. And they talk about that 90% debt to GDP level is kind of like the point of no return. We're about 122%. To look at this in a long-term historical chart, if we go back to 1790 on longtermtrends.net, we can see there were spikes during wars, right? The Civil War, there was a spike, then it came back down over the decades. Spike for World War I, didn't really have a chance to come back down that much before spiked up to a peak of 121 during World War II. That's 121%. Right now, this chart is a little bit old. It's from March, but we're sitting at around 122% right now. So we're still above that World War II peak. And you can see since really 1980, we've just been in a long-term trend higher with our national debt as a percent of GDP. So it's not like we recently just had a spike, like in the case of World War II, where there was a spike and then it could come back down to a more normal level. We've been on a 40-year long-term trend of this just growing, this debt load just growing as a percent of GDP. But here's the problem with this measure. GDP, like I said, it's a flawed measurement, and it doesn't really capture very well what the cost of that debt is, because regardless of the size of the GDP, that's not really going to give you an accurate picture of how much it's costing the government just to service that debt. So what is it costing our government to service this debt? Let's look at this chart, the federal outlays. Now, in terms of interest payments, this is interest payments on just the national debt. 2021 it came in at 352. This is in millions of dollars. So that's billions. 352,000 million. That's $352 billion, right? So 2019, 375. 2020 was 344. So, over the last 4 years, we're averaging somewhere around $350 billion every single year in interest payments on our debt. So of all of the money that the government gets in, and then all the money that it spends out, $350 billion of what they're spending is going to pay interest payments on the debt. Okay, so is that a lot? Is that a little? Well, let's take a look at how much they make from taxes. From taxes every single year is this chart, the total federal receipts. You can see that this last year, they brought in $3.4 trillion in taxes. Year before, $3.5 trillion in taxes. Year before that, $3.3 trillion. So on average, close to $3.5 trillion per year over the last couple of years in taxes that they're bringing in. That's their income. Borrowing doesn't count as income because they're borrowing, right? So this is their source of income, is taxes. So some quick math here: 350 billion, 3.5 trillion. We're looking at about 10% of all income is spent on taxes. Not spent on taxes, spent on interest payments. And so this is a big amount, right? So if we take a look at this amount of how much the federal government has been spending on interest payments, you can see that over the decades, it's been growing. It's volatile, but it's been going up, right? Well, one thing that I've talked about in the past is the debt service cost going down. So this is a chart from the Peterson Institute for International Economics. The federal debt load has gone up, right? But the debt service has gone down. The actual burden of servicing that debt or paying the interest on that debt has gone down. That is as a percent of GDP. Now, that's how we get the picture of, okay, the amount of debt, as we can see, has just been growing, and the amount we've been spending on interest payments has been growing, but the amount that we've been getting, that the government, I should say, has been getting in tax revenue has been growing much faster as a result of that GDP growth. And so we're spending about 10% of income on interest payments. And so this debt service cost has been going down. Now, obviously, taxes are not the only source of total income for the government. They also borrow to cover their shortfall. So this is a chart of their shortfalls. Every year, they take what they brought in, and then they subtract what they spend, and they have to borrow the difference. And so in 2020, that difference was a little over $3 trillion. In 2021, $2.7 trillion. So these are massive deficits. So to the extent that our government continues to spend money in excess of the amount that it's bringing in from taxes, number one, this total number just continues to climb higher and higher and higher. The total public debt continues to climb higher and higher. Now, what did I tell you, though, about the debt service cost? Debt service cost has been going down as a result of GDP going up. GDP has been going up, which has led to an increase in tax revenue, right? Your total federal tax receipts. But that is because GDP is influenced by money printing. And so the monetary expansion that we can see based on this M2 money chart, that money works its way into the economy, bids up prices, and that increases the GDP. So GDP really doesn't tell us a lot about the total wealth, the total real wealth that is in the economy. It just basically tells you the price of the economy, which can be influenced upwards by just printing more money. So the federal government has been playing this game where they're chasing their own tail by, number one, increasing their deficits. They're spending a lot more than they're making in tax revenue, and they're hoping that spending works its way throughout the economy, bids up prices, and as the prices get bid up, then taxes will have to go up, right? Because as that's all prices, as all prices go up, even without changing the tax rates, you have tax revenue increase. Stocks go up, real estate goes up, corporate revenues go up, salaries go up. All these prices of everything goes up. That means that the tax revenue increases even without making any changes to the tax rates. However, the question is, how long can they play this game? Because they've been playing this game since the 80s. So we know that interest rates have been on the decline. This is the federal funds rate. So this is the rate that the Federal Reserve targets. And it's been on the decline ever since the 80s. We've just seen it go lower and lower and lower. Every time it spikes or pops, we get some sort of a crash or recession or something like that. And then they drop it down to ease the blow. And that sows the seeds for the next greater recession, next greater crash. But we're approaching this point, we're asymptotically approaching zero, and that means that eventually we're not going to be able to play this game anymore. And so the Federal Reserve has been talking about raising interest rates soon after they finish tapering their asset purchases. Once they stop buying more bonds, they'll look at raising interest rates. But how high can they go before it triggers the next crash? Because back in the 80s, they got all the way up to 10%. And then they got all the way back up in the 90s to 6%. And then in the early 2000s here, they got all the way back up to 5%. And then in 2019, at the beginning of 2019, they got all the way up to 2.5% almost. And every single time, the amount that they can go up is a lot lower than it was the last time, and it sparks that next crisis a little bit earlier. But that's not even the biggest problem here. Sparking a crash or a crisis or a recession is not the big problem here. The big problem is what happened before this. So we look at the 70s when inflation really started to take off, and Volcker came in and he just jacked this thing up all the way. He got up to basically 20% at the top here in the 80s to get a lid back on inflation. Well, what was the national debt back in the 70s? Well, as a percentage of GDP, our national debt was down here in the 30%, right? Our national debt was tiny compared to our GDP. So what does that mean for the amount that the federal government was paying on its interest? Well, it was paying very little on its interest. In fact, it was paying so little that it could afford that cost started to climb during the 70s. So we see a huge increase in the cost of servicing debt from 1970 to 1980, but we don't see that total amount of debt as a percentage of GDP grew that much during that same time frame. Why is that? Well, because if you are rolling over your debt, you've got a certain amount of debt, it comes due, you have to pay it off, and you're going to borrow some to pay that off. Well, you can't afford to increase the amount you're borrowing if the cost of paying off that new debt continues to grow. So as interest rates grow, that means the cost of continuing to roll that debt over, meaning borrowing new debt to pay off the old debt, starts to get more and more. It starts to grow and get higher and higher. So you might be thinking, well, what is the average duration of the United States, the national debt? Because if most of the national debt is 20 or 30-year treasuries, we can raise interest rates right now because the federal government doesn't have to roll over a lot of its debt. It can just wait it out, and then maybe interest rates will be lower when that debt comes due in a couple decades. So here we need to look. We can see here that the weighted average maturity of the national debt is currently just over 5 years, right at about 65 months. And so obviously we've got some longer term debt than that. We've got some shorter term debt than that that's continually being rolled over. But on average, it's sitting at just about 5 years. Now, here's where things start to get interesting. At the current trend of our deficits and the current interest rates, interest will become the government's largest expense, more than Social Security or Medicare, in the 2030s. Well, it's almost 2022 here, so that's not that far away. Further than that, it will become larger than all other government expenses combined by 2080. Now, keep in mind, this is at the current deficit numbers and the current interest rates. Take a look here at what happens if those interest rates have to change? Well, first of all, we can see how much that interest, this is an article from crfb.org, the Committee for a Responsible Federal Budget. We can see that the interest payments already are much larger than a lot of these these line items on their budget. Here, though, we can see what happens to the interest expenses as interest rates start to go up. 1% higher, that means our interest payments now exceed our Medicaid budget. 2% higher, they now exceed total defense spending. At 3% higher, they exceed Social Security retirement spending. So very quickly here, is if interest rates go up, we saw what the federal funds rate did during Volcker's reign at the Fed, right? Went up to almost 20%. Here, we're talking about just 3% higher. It becomes the largest expense in the federal budget. Now, why is this a problem? The problem is because of what you have to do to deal with inflation. As prices rise, that is a result, I've talked about this at length, of the money supply expanding. If you want to decrease the money supply, you have to do deflationary things rather than inflationary things. We know that lowering interest rates, like the Federal Reserve has been doing for the last 40 years, is inflationary. Lower interest rates incentivize lending, contrary to what people think, because if interest rates go down, let's say they get cut in half, well, now you have to double your loans in order to continue to keep the same revenue, because the amount you're making on each dollar you lent out just got cut in half, so you have to loan out twice as many dollars. So as interest rates trickle downwards, lending is incentivized. Further than that, borrowing is incentivized because it's cheaper to borrow. So might as well spend money that you're borrowing from somebody else. And all the while, this is expanding the money supply because money is lent into existence due to the fractional reserve banking system. So every dollar that is lent out is a dollar that is lent into existence. It didn't exist before. They're not taking it from Aunt Sally's bank account and handing it to you. They're lending that money into existence. Every time you swipe the credit card, whenever you buy a car, whenever you buy a house, that money is lent into existence. That means that the opposite is true. As interest rates go up, that is deflationary. As interest rates go up, it becomes more painful to keep your debt, to roll that over. So you're going to pay that off instead of accumulating more of it. And just as money is lent into existence, as debt is paid off, it ceases to be in existence. So as debt is paid off, that is deflationary. It sucks the money supply out of existence. It actually lowers M2. And so when you want to fight inflation, that's why Volcker jacked up interest rates. It was because that's a deflationary move. You're extracting money out of the economy. You're incentivizing savings. You're punishing debt more and more to subtract and contract the money supply so that inflation will stop, or so that inflation will reverse. Because as the money supply gets smaller, that means the relative amount of money relative to all of the goods and services, all the wealth, money becomes more scarce. And as money becomes more scarce relative to all this stuff, it becomes more valuable relative to all this stuff. That means stuff gets cheaper. Money goes farther than it used to. Again, all these things, they're the opposite of inflation. So if the Federal Reserve is saying, hey, we're going to have to do, pull a Volcker to start to fight inflation, well, what happens? Well, very, very quickly, you start to have interest payments on this massive pile of debt become the only thing the government can afford to spend money on. Even just a 3% rise in interest rates would make that the largest expense that the government has, and very quickly it gets to the point where the government is insolvent. They are not bringing in enough money from taxes just to pay the interest expenses. You can say, well, what about just borrowing more? Well, that is then the opposite of what happens here, because if you have to continue to borrow more at higher and higher interest rates just to pay your expenses, just to pay your interest rate, that's going to make the problem worse. It'll be like a snake eating itself by the tail. This starts to explode upwards. That cost of servicing that debt continues to increase then, because not only are you increasing your debt load, you're also increasing the cost of servicing that debt from an absolute term and a percentage terms. All right, now let's bring it home to the final chart, the Federal Reserve's balance sheet, because this right here, this is the solution. If you just spike interest rates, you get a default, right? Government can't afford that. But every single treasury that the Federal Reserve owns is basically interest free for the government. And the reason for that is because the Federal Reserve sweeps all of its profits back to the Treasury. So the government owes trillions of dollars to the Federal Reserve. The Federal Reserve has loaned that money to the government. But all of that interest, after paying for its expenses, the Federal Reserve takes all that interest that it got and it gives it back to the Treasury. So it's better for the federal government the higher the Federal Reserve's balance sheet gets. So the more treasuries the Fed owns, the cheaper it becomes for the federal government to increase their national debt. And if the rest of the world, for one reason or another, if every holder of treasuries decides to sell them and nobody owns them anymore, and they're all soaked up by the Federal Reserve, essentially what happens then is the federal government gets a zero interest rate on its debt because it's just then paying that interest rate back to itself. Now, as that happens, which I do think there will be some things that cause the rest of the world to start dumping treasuries. The way I think this plays out is that we have after this the federal funds rate. You know, I was talking earlier about if that goes up, it every time sparks some sort of a crash or crisis, and then they have to reverse course. They've been talking about stopping their purchases of their on their balance sheet. They've been talking about making this go down and stopping it by probably June or maybe even earlier next year, and then thinking about raising interest rates after that. I think that's going to spark some sort of a market crash, some sort of an insolvency event. They're going to have to reverse course. We're going to see another spike like this as they buy up a bunch of debt, buy up a bunch of assets, and drop interest rates back down if they've already raised them up. That's the moment I think most people catch on. That's the moment I think most people realize, hey, they're not actually going to try and fight inflation here. And the more they do this, the more prices are going to go up. And nobody is going to own a treasury, a 30-year treasury at 1.76%. No one's going to own a 10-year treasury at 1.4%. If inflation is 6%, 7%, 8% every single year, you're losing a ton of purchasing power by holding that. So sell it. The Federal Reserve is going to have to buy it all. And to the extent that they do, you start to have a phase change where it's no longer national debt. It's no longer debt that's being paid off. You basically just have all expenses monetized by the central bank. You have a merging of monetary and fiscal policy there as the Federal Reserve, or your central bank, becomes just the mechanism of funding for the government. And all servicing debt costs just become a line item on paper that is meaningless because everything that the government spends money on at that point starts to transition to being funded by the printer. We're not there yet, but I think that's where we're headed here, and it's why we're not going to see a big fight against inflation by the Federal Reserve. We're not going to see another Volcker step in and try and save us because it can't happen. They can't raise interest rates. They would make the government default. And that is the absolute last thing that they want to do. So I know we covered a ton of data here, a ton of charts. I really hope this helps. Please let me know in the comments if anything didn't make sense, or if you have any further questions. I'll try and get to as many as I can. As always, really appreciate you guys. Thank you so much for watching. Have a great day.